tax computation for Mark in 1977. So, Mr. Mark, 1977 income computation. This is the income computation for tax purposes. Now, Mr. Mark will have income from employment. Income from employment, and you'll have 1,040,000. We are taking arbitrary figures. On this income, he paid payee of about 270,000. Payee 270,000. Then Mr. Mark also has some business income. Business income, in this case, 360,000. We are taking figures at random. We have Mark as some rental. Some rental income, and in this case, 600,000. Mr. Mark also has farming. Farming income, and we can give him not a farming income, he made a farming loss, not an income, a farming loss. And the loss is 2.4 million. 2.4 million. Now, these incomes in 1977 would be added together. Remember, that is where we have started from, that the losses from one source could be offset against income from another source, as we are illustrating here. So in this case, we would add 1,040,000 plus 360,000 plus 600,000 minus 2.4 million. So leaving us with a loss of 400,000. So this would be referred to as the loss for the year. The loss for the year. So this is loss for the year. Now, once there is a loss during the year, the tax on that loss would be nil. Remember, when you make a loss, there is no tax. So tax thereon would be nil, because you cannot pay tax when there is a loss. But as we can see above here, on employment income, he already unpaid payee of 270,000. So we would deduct, give a relief for the payee paid, less payee. In this case, the 270,000 would be deducted. What does that tell us? That tells us that the net tax payable is nil, but instead now there is net tax to be refunded to Mark. So net tax refundable is 270,000. The meaning of that is that the whole of the payee, which was paid on employment income, would be refundable to Mark. So here it is important to note that the tax of 270,000 would be refunded, and the loss of 400,000 would be carried forward to be offset against any income arising in subsequent years. To be offset against any income arising in subsequent years. And so we are going to look at now what would happen in 1978. This is 1977. We would see what would happen in 1978. So let's trace the activities of Mark in 1978 to see what happens. So again, Mr. Mark Now 1978 income computation. So in 1978, we are again going to trace the incomes of Mark. So we'll start again with his employment. Employment income. We will this time giving an arbitrary figure of 1,160,000. And we will take that he paid payee, payment of payee, and in this case, we can give him a figure of 295,000. $295,000 payee is paid. Then, from his business, he made some losses, business loss, and in this case, we can give him an arbitrary figure of 2.8 million. 2.8 million. And then he has some rental activity where he has some rental income of 640,000. Remember, loss is into bracket. And then farming income. From this farm, he has some income of 560,000. So we would again take the total. We gross up the amounts to see what we have. So we have 1,160,000 minus a loss of 2.8 million plus 640,000 plus 560,000. So you'd have 1,160,000, which is a loss. Which is a loss. So we have 1,160,000. No, 16,000, which is a loss. So that is the loss that you would have made. Then we take the loss brought forward. Remember, we have said the 400,000, which is a loss, would be carried forward. So from 1977, it would be carried forward to 1978. So this, we call it the loss for the year. So we have the loss for the year. On this, we bring in the loss brought forward from the previous year. The loss brought forward from the previous year, we had already carried, we have 400,000 here.